Hi there, welcome to Kneppy Invest. It is that time of the month that I do a video on the state of the market. So I usually do this video in the middle of the month, and today's date is January the 17th. The reason I like to look at the state of the markets, it's all about risk. And now there will be some people who tell you you can't time the markets, so you should always be fully invested because over time markets do rise. That is actually true to a certain extent. Markets do rise over time. But there have been periods over the past 120 years where the market went sideways for long periods of time, the 70s. In fact, when the market rose just before the Great Depression, it took something like 20-25 years before the markets got back to the pre-Great Depression highs. So even though you can't perfectly time the markets, you can actually decrease your exposure to the markets when things are looking a little bit overvalued, and then you increase your exposure in times when the market has taken a massive hit, like it did during the COVID-19 financial panic. So it's always good to understand where we are sitting right now. And in this video, I will be showing you a few charts, and we'll be looking at some indices. So the XJO, the Nasdaq, the XSO, and I think another one is the Russell 2000. And there are signals that are starting, or not starting, they have been popping up over the past year, that there is a bit of toppishness to the overall market. So let's get stuck into it. And the first thing we'll look at, I think, is the XJO, where we stood 1 month ago. If we look back at December 17, last time I did this video, I was a little bit bearish, maybe neutral, but definitely not bullish when it came to the overall markets. And the reason I was becoming a little bit more bearish was simply because the XJO was in a short-term downtrend. And that is portrayed by that sloping blue line down. You can see from the high we saw in August when the XJO reached 76.50, and that touches two more times, one in the middle of November and then in early December. Those were the two next highs, and because that sloping blue line is downward sloping, that means we're in this short-term downtrend. Now the market, or the XJO, did reach between about 72 or 71.50 and 7200 twice towards the end of September, start of October, then again at the start of December, and both times we did see some buying coming into the market. So around 71.50 or 7200 was a good support level for the overall market. So either that 71.50, that level of support, was going to be broken, and if that happened, I'd become a little bit more bearish. But if that sloping blue downward line, that trend line, was broken, then my slight bias towards being bearish or neutral would be broken as well. So let's have a look to see what occurred on the XJO between December 17 and January 17 to see if I became more bearish, or maybe my slight bearishness had come to an end. Let's have a look now. The overall market was up from December 17 to January the 14, which was the last trading day from when I recorded this video. In fact, I am recording this video just after open on January the 17th. I was slightly bearish in the last video, maybe just nearing neutral, just because of that short-term downtrend. But that short-term downtrend we saw in the previous slide was broken just after I did the video on December 17, because the overall market, or the XJO, did go on a 2-week bull run towards the end of December into the start of January. In fact, it rose from 7,300 to 7,600, or just above 7,600, and that level that it did rise to equaled, or was very near, that old high we saw back in August. That means that is a resistance level, and because that downtrend was broken, I've just put in that support level at 71.50 because the XJO has not gone below that. So right now, instead of being bearish or bullish on the market, I'm right in the middle. I am neutral because it does look like the XJO is trading in a range between about 71.50 and about 76.50, or just below 76.50. And that means I'll become bullish if the market goes above that resistance level at 76.50, or I'll become bearish if the market goes below 71.50. So all I'm doing here is reading what the market is doing. And that's how I play this game. I don't try to predict where the market is going to go. I will react when the market shows me which way it is going. At this point in time, the market is going sideways. And until I see evidence that the market's going to go higher or lower, I am not going to react either way. So I'm not going to sell all my shares or buy more shares. So at the moment, I do have a little bit of cash. And if I see 76.50 broken, I will deploy a little bit more of my cash. But then if I see the market go below 71.50, I will sell out of some of my companies and go a little bit more into cash. I won't go completely into cash like some investors out there, but I will decrease my risk. Now let's have a look at the Nasdaq, and I have been fairly bullish about the Nasdaq for quite a while, and all these stars I've shown you in not only this slide but other slides is buy the dip opportunities we've seen in the market ever since COVID-19 financial panic, because there's been a lot of opportunities, a lot of buy the dip opportunities. In fact, for the Nasdaq, there has been 6. But the last potential buy the dip opportunity could be the turnaround point for the Nasdaq. And what I do have here is 3 moving averages, the 25, 50, and 100-day moving average. And the buy the dip opportunities is whenever the Nasdaq gets right on the 100-day moving average, or just for a few days falls below the 100-day moving average. It seems like that is or has been a really good support level for the Nasdaq. And of course, day-to-day trading for all companies and markets is all about psychology. And a lot of investors, when they see the dip in the Nasdaq, they see the Nasdaq fall towards the 100-day moving average or fall below it, that's when they go and buy more companies or ETFs. And we have, or the Nasdaq has dipped below the 100-day moving average right now. But unfortunately, the Nasdaq has also dipped below the previous low. So there is signs that the growth in the Nasdaq we've seen, or the significant growth in the Nasdaq we've seen since the COVID-19 financial panic, could be coming to an end, or at the very least, there could be a pause to this run we've seen with the Nasdaq. So until I see further signs that the Nasdaq is going higher or falling lower, I would be right in the neutral area for Nasdaq, just like I was or am with the XJO. Now to an index I really haven't shown in the State of the Markets video, and that is the Russell 3000. And the Russell 3000 index looks at the 3,000 top companies in the United States, and this accounts for 97% of the value. The only reason I'm showing you this particular slide, and it's very similar to the Nasdaq, so there is a lot of crossover between the two, and in fact they should be quite similar, because most of the biggest companies in the United States are either on the Nasdaq or the S&P 500 and the Dow Jones as well. But the reason I wanted to show you this is in the next slide, I'm going to show you the Russell 2000. And the Russell 2000, instead of looking at the top 3,000, it looks at the bottom 2,000 of the Russell 3000. So it ignores the biggest 1,000 companies in the United States. And when you look at the Russell 2000, you get a completely different picture. So let's have a look at the Russell 2000 right now. So again, the Russell 2000 is just the Russell 3000, but excluding the top 1,000 companies. So the Russell 2000 doesn't include Microsoft, Apple, Tesla, Nvidia, all those sort of companies, those really big companies. Now, when you do look at the Russell 2000, you see a completely different picture from the start of 2021. In fact, throughout most of 2021, the Russell 2000 was going sideways, and that has continued into the start of 2022. Not only that, there's a real powerful, strong support level at 2120. In fact, the Russell 2000 has touched this support level 8 times over the past 12 months. And right now, it is right above that support level. And that means if that support level is broken, that would be a significant bullish or bearish move by the Russell 2000. And that's a reason why I'm paying close attention to what's happening to the Russell 2000. And there is that potential that if we do go below that 2120, that could be the beginning of a bear run for the bottom 2,000 companies in the Russell 3000. Now, when it comes to the Russell 2000, I'm not sure we can call the Russell 2000 a small cap index because I'm not sure the market caps of some of those companies in it. But there is a small cap index for the Australian market, that is the XSO. So usually focus on the XGO, which is looking at the top 200 companies on the ASX. The XSO is looking at the small caps. And the reason I like to look at the small caps and how they're performing is usually when there's a downturn in the market, when we do go into a bear market, it's usually the higher risk companies that fall first. So we usually will see a bit of a downtrend developing in the XSO, in the Russell 2000. And we've already started to see high risk assets like non-profitable companies actually starting to fall quite significantly in the United States. And I'll show you a couple of slides in the future that will back that up. So as we look at the XSO, I won't say it's bearish just yet, but there is signs of some bearishness, a definite resistance level at 3,600, and you can say that the XSO has been going sideways over the past 4 or 5 months. And if we do see the XSO fall below about 32 or 3320, which is the previous low we saw at the start of December, that would be a significantly bearish move. And right now, I am still a little bit neutral when it comes to the XSO, just like I am with the XGO and the Nasdaq. But there's other reasons to be a little bit bearish when it comes to the overall market. And I'll show you some of those reasons during the rest of this video. The information from this slide comes from the Felder report, and this comes or is produced by Jesse Felder and his crew. Now, to warn you, Jesse Felder is or does tend to be a little bit of a bear, so we'll say negative, and he is looking for proof that the markets are in trouble and about to move into a bear market. And this particular chart is called the bad breadth, and it's looking at the Nasdaq composite, which is the blue line that has been going up since April 2021. And the other line is the percent of companies in the Nasdaq with the share price above the 200-day moving average. And that actually has been decreasing ever since April last year. And right now, only 30% of companies on the Nasdaq are above their 200-day moving average. That means 70% of companies right now are in well-defined downtrends. And that's actually not good news. That means the heavy lifting done on the Nasdaq is by a select few companies. And those select few companies are the big companies. The Apples, the Microsofts, the Teslas, what's another company? Amazon, those sort of companies are doing all the heavy lifting. And history has shown in the past that the first companies that do move into a downtrend are the higher risk companies, like the smaller companies on the Nasdaq. And just go have a look at some of the charts of these smaller companies on the Nasdaqs. They're higher risk companies, the companies that are not in profit just yet. And some of these companies' share price are down 50 to 70%, even more. And that is the first sign that we could be in a little bit of trouble when it comes to the markets, not only on the Nasdaq, but also around the world. The next chart here also comes from the Felder report, and this is just looking at the Buffett yardstick, comparing the market cap to GDP. And right now, it's had historic highs at 300%. During the tech bubble crash, it reached about 200%, and it fell all the way down to about 75% during the GFC. But the higher this gets, the more likely or the lower your expected returns in the future will be. Now, in saying that, the reason we've seen this really rise from the mid-80s is because of significant tailwinds for equities. And the biggest tailwinds for equities have been lowering interest rates. And the other tailwind we've seen since the COVID-19 financial panic has been massive stimulus. And that's why we've just seen this market cap to GDP over the past 2 years just rocket up at an exponential rate. Now let's have a look at something really interesting when it comes to the Buffett yardstick if you invert it. So let's have a look at the next slide. This chart is also from the Felder report, and what Jesse Felder and his crew have done here is inverted the Buffett yardstick and then compared it to the returns, in fact, the forward 10-year returns, which is in the blue line, or shown in the blue line here. You'll notice the blue line only goes to 2012, because in 2012, that's the expected returns you would have had in 2012 for the next 10 years at about 12.5% per year. And you can see there is a bit of a correlation between the inverted Buffett yardstick and forward 10-year returns. Not a perfect correlation, you'll never see that, but there is a good correlation. And this should scare you if you understand this and believe that that correlation will continue for the next 10 years. Because right now, the Buffett yardstick is at negative 12.5%. And that means, if you believe this chart and everything it's saying, that the expected returns, per year returns, for the next 10 years will be negative 12.5% per year. Now, I don't believe that, because I don't think that blue line will mirror that red line, which is the Buffett yardstick, perfectly. But it is telling us there is a greater chance that our returns over the next 10 years will significantly disappoint from what we've experienced in the past 10 years. Now, I'm going to talk about briefly Cathie Wood, because she's been all the talk over the past few years. Her funds were performing really good, and I do have a look at her videos now and again. And the main reason I want to talk about Cathie Wood is there's a lot of fund managers that really do spectacularly well over very short periods of time. And a lot of times those fund managers who perform spectacularly don't last very long, because the reason why they perform very well is the reason why they actually don't perform over long periods of time. And that is why Warren Buffett and investors like him, who have been around for decades and do perform really well through all sort of market cycles, are the best sort of investors. And you can actually compare Cathie Wood to a guy called Garrett Van Wagner, who was all the rage back in 1999. And I found this article written in that year from Investment News, talking about Garrett Van Wagner. And there are a lot of similarities between Van Wagner and Cathie Wood here. So here are a few quotes from this Investment News article. Van Wagner Technology Fund, which is very similar to the sort of the names that Cathie Wood has for her funds, soared 85.1% in comparison with the Nasdaq Composite Index, 39.6%. They also mentioned one of these other funds performed considerably better than the Russell 2000 and the Russell 2000 growth indexes. And then there's a couple of other quotes that are trying to talk about why he has been successful. For instance, there was a guy called Chris Trollson, an equity fund analyst at Morningstar, trying to describe why Van Wagner was a successful fund manager. He still buys companies he thinks are on the cutting edge of some industry that's about to get hot. That's extremely similar to what Cathie Wood has been doing over the last few years. And there was another quote in regards to interest rates, which I found really illuminating. Today, Van Wagner sees the beginnings of an upcycle thanks in part to low interest rates. And that's exactly what Cathie Wood is banking on for the success of her funds. She needs interest rates to remain low. And if you have a look at any of her videos, she's always harping on about inflation being transitory. Interest rates will remain low forever. And maybe I'm being a little bit exaggerating there. But she does expect interest rates to remain low for a long period of time. So a lot of similarities between Garrett Van Wagner and Cathie Wood. And just be aware, whenever you see a fund manager being really successful over a very short period of time, don't get entranced by that performance, because more than likely it's only a very good short-term performance, and that performance won't continue in the future. In fact, more than likely it'll actually turn around and become bad performance, and we're actually starting to see that with Cathie Wood's funds right now. So how did Garrett Van Wagner go over the subsequent years, particularly from the tech bubble burst? Because most of these investments were in those sort of companies that absolutely did not perform well during the tech bubble. In fact, most of the companies went bankrupt. And in fact, if you bought into his funds just before the tech bubble burst, you probably would have lost most of your fortune or your wealth. And Garrett Van Wagoner finally gave up in 2008, but not for good, because he came back on the scene, I think about 2011, 2012, because he saw some opportunity. And actually, this was maybe Garrett Van Wagoner's best move, because that was the best time to start investing or return to investing, because that was near the bottom of the market. It is really good to see that there has been some articles written about the fact that you shouldn't be enticed by how Cathie Wood's funds have performed up until the start of 2021. This is an article in the Institutional Investor written by Christopher Schelling and released on the March 9, 2021. Cathie Wood was last year's hottest investor. It definitely was. She was everywhere at that point in time. But is there a lesson for her fans in a forgotten 1990s icon? Question mark. Garrett Van Wagoner had the golden touch in tech stocks, and then 2000 happened, and he was never heard of again. Well, almost never heard of again. Could that happen to Cathie Wood? Well, it remains to be seen, but 2021 was not kind to Cathie Wood and her funds. So let's have a look at one of her funds right now. This is one of the funds that Cathie Wood does run from Ark Invest. This is the Ark Innovation Fund, decode ARKK. And up until the start of 2021, Cathie Wood and her funds could do no wrong. Well-defined uptrends, and in fact, this fund went all the way up to $160. But then something happened. The majority of companies that Cathie Wood invests in and thinks really highly of, their share price started to fall, except one, and that was Tesla. But the majority of companies that Cathie Wood invests in are not profitable. In fact, they burn through prodigious amounts of cash. And I think the market is finally understanding that. And that's why this particular fund, this Ark Innovation Fund, has halved in price since February 2021. It has gone from $160 to a current price of $80. And I found this from Twitter, source Bloomberg, and this was created by Crescat Capital. It's comparing the performance of that innovation fund I showed you in the previous slide to Tesla, which is the largest holding in this particular fund. And up until the start, or the February 2021, there was a pretty distinct correlation to the performance of this innovation fund with Tesla. There was almost 100% correlation, but that correlation ended in February of this year. So even though Tesla's share price has gone through the roof, has moved higher, the Ark Innovation has fallen. So there is a disparity between how Tesla's performed and how this Ark Innovation has performed. And the reason that's important is that's telling us that the rest of companies that Cathie Wood has invested in, or the majority of companies, have performed absolutely miserably during 2021. And those companies are the smaller companies on the Nasdaq. And that is also telling us that there is a lack of investment, a lack of money moving into these higher risk assets. And I think that right now the majority of money is moving into the lower risk assets, the higher value companies on the Nasdaq. There's companies like Apple, Microsoft, Amazon, and even the share price of some of those companies are starting to struggle now. So this is a potential sign that we might be moving into a bear market, or at least a market that will go sideways for a period of time. Although I do believe we are seeing increased possibilities or probabilities that the market might be moving into at least a sideways movement or maybe even a downtrend, I'm not at this point in time reacting with 100% conviction that's going to happen. And it's all about managing your risk. So at this point in time, I have taken a little bit out of the markets. So I have increased my cash just because the probability of the markets turning into a downtrend has increased. And if that probability starts to decrease and I see some bullish moves, I'll increase my investments in the market and decrease my cash. On the other hand, if I see increasing probabilities that the market is moving into a downtrend, I'll increase my cash and take some of my money out of the markets. And that's what I'm doing. I'm just managing my risk. You will hear some people say you should always be fully invested in the markets because you cannot time it. But you don't or can't completely time the tops and the bottoms, but you can manage your risk. And that's one of the most important things I've learned over the past 5 to 10 years. If you have any questions about what I've talked about in this video, just leave it in the comment section of this video. Otherwise, I'm not a financial advisor, but if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.